Hello again, everyone. This is Gene Ahrensberg coming to you on Sunday, June 9th, 2013. Well, we may be heading into the usually sleepy summer months for the precious metals, but the setup for the futures markets for gold is anything but sleepy. In fact, it wouldn't take all that much of a trigger to turn the futures market into 1,000 tons of TNT. We'll explain in a minute, but first, this week gold tested above the important $1,400 level before getting sold back down on Jobs Friday. The BLS guesstimated Goldilocks-style 175,000 jobs were created for May. Gold knee-jerked lower, knocking all of the week's hard-fought gains out and resulting in a $4 net loss for the calendar week. Silver took a torpedo amidships for a much larger 2.6%. as apparently the sellers managed to get down below tight trading stops, including ours. This is the daily chart. We were stopped out for a roughly $1 gain. As you know, we consider any trading payday as a good day, but we had higher hopes for this trade than a mere $5,000 per contract. Such is trading. It was clear to many traders that someone really wanted the market to think the so-so jobs number was a big negative for gold. It isn't, of course, but when it comes to the futures market, very short-term perception is 9/10 of reality. We know someone hammered the gold market for effect because someone once again threw oversized, probably illegal size into the market in blitz fashion, and we think pretty obviously in this case because the actor who did the blitz actually fired the sell for effect order a little ahead of the actual 08:30 a.m. release of the jobs data. Our friends at Zero Hedge had a good article on it, but we wouldn't waste too much time on this issue. The CFTC under Goldman X Gary Gensler is unlikely to enforce anything like position limits or illegal trading for effect. As we've recently written, the CFTC apparently ignored blatantly obvious violations of the position limits on May 12th, and they triggered and perhaps became camouflaged by a cascade of other trading stops. It happened again on May 20th. That's two recent examples we know of, three if you count Jobs Friday, June 7th. Now, just so you know, we figure as long as the CFTC looks the other way when position limits are violated in future bull rushes, where the bulls are doing the oversized trading and pressing the upside, then it'll work out or even out in the wash. Besides, complaining to the CFTC is next to worthless and therefore a mostly non-productive use of valuable time. At least it has been. More importantly, we also figure that a market is unlikely to actually break down or break out unless it's otherwise ready to do so. So pointing out trading violations is kind of like blaming the referees for not making a call when your team loses a game. The fact that your team lost because a referee didn't do something means your team didn't do what it takes to win. Period. Full stop. That doesn't mean it isn't irritating to see it in real time. It is. Let's move on. We're determined to keep this video as brief as possible, so we'll skip some of the usual descriptions and jump right into the main course of the message. As you know, we track the Commodities Futures Trading Commission commitments of traders reports each week and report our findings in weekly commentary directly in the private linked Got Gold report charts. So what we're going to talk about today is our impression of where we are as of the June 7 report, which has data as of Tuesday, June 4th. Remember that the COT week is from Tuesday to Tuesday, as shown here. So what we're about to review occurred before the Jobs Friday sell down. Today, let's take a quick trip through all the large trader positions and see if we can describe them in just a few sentences. Starting with the producer merchants, the commercial traders that include the largest bullion dealers, refiners, producers, jewelry manufacturers, and some of the bullion banks many of them end up trading through, they remain near their least net short position for gold in years. They're positioned about the same way they were during the 2008 panic, which was a major turning low for gold. Remember, this chart shows the net position as a negative number, so the higher the blue line, the lower the net hedge position of the producer merchants. Just because the producer merchants are positioned as they were near the end of the last major correction for gold, when gold was then testing the low 700s, doesn't necessarily mean that gold has reached the full and final end of this current correction, but it's the best data we have to look at, and therefore relevant to our attempt to position for a possible reversal of the trend. Looking just at the producer merchant short positions, at just over 100,000 contracts, the producer merchants are getting pretty close to their lowest gross short position in DCOT history, which occurred November 4th, 2008, during the heat of the 2008 panic. Just 91,000 and change shorts then, with $763 gold. Just looking at the graph, we can see that the producer merchants, whose job it is to hedge against a falling price of gold, are near their lowest gross short position. That's the same thing as saying the big hedgers are positioned more for higher gold than lower gold. Are they right? Moving to the mercenary swap dealer commercials net position. Remember that last week the swap dealers covered or offset a huge 28,138 contracts of their net short position in 1 week. Well, this week they put 6,872 contracts net short back on, but at 28,522 contracts net short, the swap dealers, who we think include at least one mercenary U.S. bullion trading bank, and we'll show you why we say that in a moment, are now much closer to their least net short position for gold than their most net short position. And notice, please, that as of June 7th, they are about the same position that they were during the 2008 panic. Looking now at the swap dealer gross shorts, we can see the big drop in their shorts last week, and at 71,906 contracts, they're now also closer to their least amount of gross shorts than the opposite. Moving to the traders classed by the CFTC as managed money, including hedge funds and commodity trading advisors, who we often call just the funds, we think it's interesting that the funds have remained near their lowest net long positioning on the graph, and very similar to where they were positioned during the 2008 panic, where the last major correction for gold found ultimate support. While we're here, notice that over the last 2 reporting weeks, the managed money traders have actually increased their net long positions, not by much. Moving to the managed money gross shorts, this is the second consecutive week that the funds reduced their gross shorts, this time by 8,573 lots with gold near $1,400. Recall that just 3 COT reports ago, the funds reported their highest gross short position in DCOT history, so the funds have begun to reduce their spec short positions. It'll be more convincing when they get back under, say, 30,000 shorts. But reducing them by roughly 9,000 contracts per week that's not chopped liver. That takes us to the other reportables, which include very large traders like pension funds, large private wealth, sovereign funds, and other very large traders who trade futures for their own book as opposed to trading for clients, like managed money does. As the graph shows, the other reportables can be blamed for a good deal of the net selling pressure on the COMEX just recently, and take a look at the stunning plunge in net long positioning there. From a DCOT record high 76,511 net long contracts on March 26th, all the way down to just 7,612 contracts net long June 4th. That's a reduction in just a little over 2 months of a whopping 68,899 contracts, or 90% of their formerly large net long position. Listen up, because this is important. We can point to only one other time when the other reportables did a kind of sudden harsh reduction of their net long positioning. That occurred in late 2010 and early 2011, as shown here on the graph. Interestingly, it occurred just ahead of the largest and most important bull rally for gold ever in 2011. Gold surged then from, call it the 1340s in February, up to its parabolic blow-off top in September near $1,923, a $580 major definition move, or about 43% in 7 months. Again, that was right after the other reportables had gone from a near record high net long position in November of 2010 of over 52,000 lots net long down to slightly net short as of March 15th, 2011. From record net long to a little net short in a few months just before gold caught a whopper of a bid. That's very similar to now, isn't it? We have to wonder if history is repeating itself in this gold correction. Now let's take a look at the other reportable short positions. A majority of the reduction in net longs by other reportables was a 37,988 contract increase in gross shorts, as shown here on just their short positions. In a moment, we'll try to connect a few dots using the other reportables, swap dealers, and the U.S. Bank positioning chart. So remember this highly unusual and abrupt change in the other reportable positioning. We've come to the last DCOT category, non-reportables, or traders who trade under the number of contracts required to report to the CFTC. As you can readily see, non-reportables, who we call the little guys, even though some are really quite big firms and have ample funding, the little guys are about net flat following this major gold correction. This week, non-reportables actually reduced their already tiny net long position by 1,890 lots to show a minuscule 452 contracts net long, essentially net flat. Notice that with gold having tested as low as the 1320s and near $1,400 on June 4th, the net position of the little guys of gold futures is actually below where it was during the 2008 panic. Someone might look at this chart and conclude that the mostly trend-following smaller traders had blown out all their long positions, but in the next and final DCOT graph, we'll see a little bit different story. This is just the gross short positions of the smaller traders. Notice that the vast majority of the large amount of net long reduction by the little guys was not long liquidation, but instead it was a very large increase in their gross shorts. Just the last COT week, on May 28th, non-reportables showed their largest gross short position in DCOT history, a big 42,341 lots. This week they actually reduced their shorts by 6,863 contracts, joining their larger cousins in the managed money category in the short reduction business. Contrarians look at that high gross short position for non-reportables, and when added to the still huge gross short position for managed money traders, and let's look at that, they see an enormous amount of high-octane rally fuel, future short covering horsepower. That's once it becomes clear that the downward impulse for gold has reversed course again, like it did in 2009. Now, we've looked at the reported positioning of the gold futures traders individually, but before we try to summarize them, let's take a side trip into the most recent Banks and Futures report, which is published monthly by the CFTC and came out on Friday also. In the June 7, 2013 CFTC Monthly Bank Participation Report category for U.S. banks, please note an interesting and some might think stunning change. Recall last month that less than 4 U.S. banks reported being 16,781 contracts net short gold futures. That in itself was already a fairly low net short position for U.S. banks in gold futures. As of June 4th, still less than 4 U.S. banks reported a net long position of, that's net long position, of 29,622 contracts. So as gold fell from $1,452 on May 7th to $1,399 on June 4th, call it $53 or 3.7% down. The U.S. banks flipped from net short to net long by a total difference of 46,403 lots in just 1 month, from 16,781 contracts net short to 29,622 contracts net long. Now, this graph charts the net short position of U.S. banks in the futures only report. A negative number, like showing now, is actually a net long position for the banks. Isn't that interesting that the U.S. banks now report a net long position? But where can we account for the 46,000 contract net change in the data of the other traders in the CFTC reports? We're talking about U.S. banks, remember, since it is less than 4 banks, and since the change was so large in just 1 month, it ought to be visible in the positioning of the other commercial traders, shouldn't it? A sudden change like that is kind of like elephant tracks in the commitments of traders reports. First of all, remember this past month saw the other reportables, which probably include pension plans, private wealth, etc., closing out their oversized long futures positions and presumably the other side of their hedges elsewhere. At the same time, the U.S. banks have now gone net long. We think this is an important development, and we can't overstate it. Notice that over the past month that while U.S. banks were essentially net buyers of 46,000 lots, it is the swap dealer commercials where the bulk of that change shows. On May 14th, swap dealers reported a net 57,080 contracts net short. On June 4th, the day the bank participation report showing the new net long position for U.S. banks cut off, they reported just 28,522 contracts net short. Swap dealers covered or offset 28,558 contracts on a net basis. Looking just at the swap dealer short contracts again, they closed or covered about the same number of contracts, about 28,955 lots. This shouldn't surprise anyone. Goldman Sachs is a bank too. The point is, the big change this month did not come totally from the producer-merchant commercial category, as some commentary we've seen on the web implies. For that same period, the producer-merchants actually increased their net short positioning by a small 6,064 contracts from a DCOT record low of 27,066 to 33,130 contracts net short. Looking just at the producer-merchant shorts, they did decrease their gross shorts by just under 30,000 lots. So there is room in that number to pick up the balance of the large net change by U.S. banks in the bank participation report. But again, the bulk of the change is apparently connected to the swap dealer category and cannot be explained by the producer-merchant category of traders alone. Let's draw a line here and say that if the U.S. banks are now reporting a net long position, and they are, that is certainly interesting, and we just about have to put that on the bullish side of the COT ledger. At least we can say that the U.S. banks now consider the price risk as to the upside. Our sense is that the big change in the bank participation report is not only connected with the swap dealer report, but also directly connected to the huge drop in long positioning in futures by other reportables. We can't see, in the case of the swap dealers or the other reportables, what the positions those futures positions hedged, in other words, outside of the futures bourse. But we can look back in time to see what happened the last time. So let's try to work to a bottom line for what it all means. And for that, we think we can go back to the pretty girl that brung us to the COT dance in the first place, the good old legacy COT report, which of course includes and amalgamates all of the commercial trader positioning we've been talking about. And for our purposes today, we can focus on just one chart in the legacy COT report. This is the net positioning of the traders the CFTC classes as commercial, which includes producer merchants and swap dealers in the same category. As of last week, May 28th, with gold then $1,380, the combined commercial traders reported their lowest net short positioning for gold futures since May 31, 2005, when gold changed hands for $417 the ounce. Going back to October of last year, the big hedgers had put on hedges and net short bets equal to 27 million ounces. As of last week, their net hedges were less than 6 million ounces. When you boil down all this COT stew, what this graph represents is the desire on the part of the largest, best funded, and best informed traders of gold futures on the planet to hedge their metal exposure or their desire to bet that gold will go lower in price. And what this graph is telling us today, with gold near $1,400 or so, is that the big hedgers are the least motivated to hedge gold in 8 years. We here at Got Gold Report believe that is the same thing as saying that the big gold hedgers have the least expectation that gold will fall significantly further in price than they have had in 8 years. I think the issue is and always will be how far the slingshot can be pulled back before it gets released. And that's the essence of tracking the COT reports. I think it would be extremely difficult to make a case that the slingshot has not already been pulled way back. Therefore, although the COT slingshot can be pulled back even farther, from a contrary point of view, it's just a question of time before that release point is found. Looking through the matrix of all the various positioning of COT participants is like looking at a half a dozen slingshots all pulled to the extreme release point. We argue that the swap dealers and the other reportables have already snapped in a way, and let's look at the other reportables. These are violent changes in COT positioning. And now we see U.S. banks showing a net long position. These position changes are connected. Is this the beginning of the release point for these very taut slingshots? Is a sure enough turn in the gold market starting to happen? Who knows? But the setup is as long-term contrary bullish as it is very, very short-term dangerous in our opinion. To see the U.S. banks now net long gold futures in a meaningful way for the first time since probably in 2001 suggests the smartest hedgers in the world now see the risk to the upside. Are they right? We see the current COT setup as very strongly contrary bullish, but nobody can see the future. All we will ever have is indications, and we have to just do the best we can with them. We cannot know for sure if this wildly bullish COT setup is right or not in advance, and who knows what's going to come out of the woodwork. But we can and always do use trading stops to keep us out of trouble if our read of the tea leaves is premature or just plain wrong, and if the trading goes strongly against us. That's why we always say, and mean it when we do, mind your stops. That's it for this brief update on the commitments of traders' reports. We hope you found it interesting and worthy of your time. Thanks for watching, and we'll see you all again next time. Bye for now.